Hi everyone. Grab stocks has started to see stronger trading volume again. Grab is a much better place than before, but the stock price is still stuck around the low $3 range. So today we are going to break down what Grab companies actually is and why the stock price is still stuck around $3 even after a lot of positive news. Before we start, I post the global market news every morning on my YouTube shorts. I strongly believe this will help your investment decisions. Please check them out and subscribe to the channel so you don't miss any of them. Okay, then let's get started. Grab is a Southeast Asian super app based in Singapore. It first started in Malaysia as a taxi booking app, but today Grab runs ride booking, food delivery, grocery delivery, payment, loans, and even digital banking. Grab calls itself Southeast Asia's everyday everything app. Sounds about right. In simple terms, Grab is trying to put Uber, DoorDash, Paper, and digital bank inside one app for Southeast Asia. And the company has started to show real profit. It is also Southeast Asia, a market with a huge young population and strong long-term growth potential. Let's look at the numbers. Grab reported 955 million in revenue in the first quarter of 2026. That was up 24% from last year. Adjusted EBITDA was 154 million, up 46% from last year. The company also capped its full-year guidance revenue of 4 to 4.1 billion dollars and adjusted EBITDA of 700 to 720 million dollars. But the market is still not fully convinced. The first reason is the Southeast Asia consumer market. Southeast Asia has a strong growth potential, but it is not a rich consumer market like United States. Grab still needs discount, promos, and low-cost options in ride booking and food delivery. So investors are not only asking, is revenue growing? They're asking a more important question, is this growth really profitable? That is like people are hesitating to invest. The second reason is Indonesia risk. This is something many US investors may miss. Indonesia is not just one country in Southeast Asia, it is the fourth most populated country in the world. Did you know that? And it is the largest economy in Southeast Asia. So if rules change in Indonesia, the whole Grab investment story can change. Recently, Indonesia's government said it wants to lower the fee limit for ride booking companies. Right now, companies can take up to 20% from drivers. The new limit could fall to 8%. The government also wants stronger driver protection, including insurance and health-related support. So Indonesia government want to give more credit to the workers than company. This is kind of disappointing news for us, and also this can impact directly for Grab's revenue. Grab may have to take smaller fee while cost could go higher, and this is happening right when Grab is just starting to show better profit. So one of Grab's most important market is now facing more pressure from regulation. The third reason is GoTo. The key competitor we need to compare with Grab is GoTo. GoTo was created by combining Gojek and Tokopedia in Indonesia. It runs ride booking, food delivery, logistics, and fintech. GoTo has also shown a better profit trend recently. In the first quarter of 2026, GoTo reported its first quarterly net profit and revenue grew 26% from last year. But the valuation is different. Grab is now trading at around 2.9 times EV to revenue and about 15.7 times EV to EBITDA. GoTo is trading at around 2 times EV to revenue. So Grab is already getting a premium over GoTo. That premium makes sense because Grab is not just tied to Indonesia alone. It operates across Singapore, Malaysia, Thailand, Vietnam, Philippines, and other markets. And the market also seems to trust Grab's profit path more than GoTo's right now. But this is also means we cannot simply say Grab is extremely cheap. It already traded at a higher valuation than GoTo. In the short term, there are still reasons for rebound. Oil prices have recently moved lower, and Brent crude fell about 8% for the week. Grab does not directly pay for every driver's fuel cost, but lower oil prices can reduce pressure on drivers, customer prices, and increase tourist volume. For ride booking and delivery platforms, that can be a positive short term factor. So, in the near term, better earnings and lower oil prices could give the stock a reason to bounce. But for the long term, oil price is not the main point. Grab needs to prove that it is not just the Uber of Southeast Asia. It needs to prove that it is the profitable super app. Their company strategy is simple: use ride booking to bring customers, use food delivery to make people open the app more often, then use payments and loans to build financial data. If this model works, Grab is not just a transport company, it could become a key part of Southeast Asia's consumer finance system. But the market is not giving Grab the full value yet. There is regulation risk in Indonesia, consumers are very price sensitive, and Grab still needs to prove that it deserves a higher valuation than their competitors. So the reason the Grab looks cheap is this: investors are still trying to figure out whether this is a real long-term turnaround or just a short-term improvement that could be hit again by the regulation and competitors. For a major long-term re-rating, Grab needs to keep proving the numbers. I think if Grab can profit for two straight quarters and keep showing steady growth, I think the stock still has a room to more than double within a year from current price. The market does not just want a cheap price; the market wants a stronger proof. Thank you for watching my video today. I'll come back with another interesting stock and market news. See you in the next video.